Will today be the end of the streak for Tesla? Will 12 days, which would be a new record for this streak of Tesla running, will this be it? Will it be it because of the Fed? Is the Fed about to rug pull us? Is the stock market about to crash? Are we hitting resistance? What's going to happen in the coming days? We're going to talk about it. We're going to talk about inflation. We're going to talk about Tesla, why Tesla may be immune from it, and why Tesla may be affected. Welcome back, everybody. If you're new, my name's Nicholas, and this is Investing Against the Grain. Do me a favor, like, subscribe, hit the bell, do all those good things. All right, let's go ahead and start off by talking about what's going to happen this week. Right, tomorrow we will go ahead and we will get the new CPI numbers. Right, so remember it's from the previous month, so we're in June, so we'll be seeing the May CPI numbers. So let me share my screen because I want to talk to you about what is actually happening, right? Like where we are right now and what we can expect. So let's start off by letting me share my screen here. All right, so I'm going to zoom in a little more just so that you guys can see as clear as possible. Okay, so here we can see we essentially have the trailing 12 months here of CPI, right? So here you can see the over the year, right? This is an aggregate. This is taking the last 12 months of CPI information to let us know where inflation currently is at. All right. So again, the Fed wants to get this number here down to 2%. Here you can see that in June we hit our peak of 9.1%. So what's going to happen and why I've been saying that inflation numbers, CPI numbers should drop off precipitously over the next 2 months is because of the following. So first of all, let's look over here. This is over the month, right? So this is what we're doing. We're adding 12 months of these, right, in order to get these numbers over here, right? So that's essentially how it works. That's that rate of change so that we know what CPI is. But here's the big difference. If we come down here, we are about to get the May numbers, right? So in May, we were at 8.6%. And so as part of the calculus to get all of these numbers, right here, you see 4.9. You see it's coming down, coming down, coming down. But part of this 4.9% is factoring in this May 1.1%. So that's a big weight on it, right? It's like in school, whenever you would take all these tests and you could have straight A's, but then you get one F. If you got one F, all of a sudden your average came way down, and it was almost impossible to get back up to a good average unless you could just somehow get rid of that F. Right? This is an extreme example. Hopefully that doesn't resonate too much with you guys. But the point is, once we can get rid of this 1.1%, all of a sudden this total number of here for inflation looks a lot better. So this main number is going to be wiped away, this 1.1%. And we look up here, we can kind of see this trend, right? Here we see some zeros, we see some negatives, we see 0.8, 0.6, 0.5. We don't know what's going to be. We'll see what the estimates are. But the point is, we definitely aren't in the 1.1%. So it should definitely be lower. Even if you took the 0.5 here, for example, you would see a lot lower, right? And then don't forget, in July, which will be a reflection of June CPI number, previously we had 1.4%. This will also be erased. So we should start to see some truer numbers. Now, the only scary thing is that if these month over month numbers don't start to kind of become a little smaller, things could look a little worse come, August, September, when we have these 0% that we're lapping. So that might tick back up slightly. So we'll have to keep an eye on this. But either way, over the next two months, we should see CPI come down precipitously. Okay, so that's great and all. But what's actually being expected? Okay, so hopefully this makes sense. Hopefully everyone understands this. If you want, feel free to go to this website to figure it out. It's kind of fun to play with these numbers. But let's go ahead and let's take a look over here. So let me blow this up a little bit. Here we can see Jerome Powell looking a little pensive. So, okay, let's see the nowcast. So the Cleveland Fed nowcast suggests month-on-month inflation will come in at 0.19%, and core inflation will be 0.45%. That would lead to annualized inflation rates of 4.1% and 5.3% respectively. This will continue the trend of headline inflation dropping below core inflation, and as we've seen in March and April CPI figures. Okay, so let's break this apart slowly. So here we see the 0.19%. If I come back to this, right, that 0.19% is going to replace this 1.1. So 0.19% is great because not only does it show that these higher numbers here, 6, 5, 0.8, it'll be 0.19, so that'll be 0.2. That's essentially the lowest we've had since we've been negative, assuming they're correct here. So when they're talking about this, right, and they say that would lead to an annualized inflation rate of 4.1% and 5.3% respectively. Well, what's the 5.3 and the 4.1? So the 4.1 would be what we're seeing here, right? That's just true in CPI, the actual number. The 5.3 is when they assume core CPI. So what is core CPI? So core inflation or core CPI is essentially just the CPI number, normal CPI number, right? Of all the different categories that they look at, but they subtract out energy and food. And the reason they do this is because, for better or worse, they think that energy and food are very volatile. So they want to get an understanding of what core inflation is and see where the stickiness might be within the market. Now, there's a lot of people that say that a lot of this inflation decline is really just energy, and there could be some truth to that, but I think there's more at play than just that. But so that's the reason for that. And so, from a Fed perspective, when we're still looking at this 4.1, 5.3, they want to see core drop as well. They want to see inflation drop holistically. They don't want to see just a portion of it. They want to see everything come down, and they want to make sure that there's no stickiness or any bad actors hiding in the woodworks. So that's all that core inflation is. Again, it's just food and energy subtracted. Okay, so this outcome, if it holds, would also continue the narrative that headline inflation is coming down, helped in part by falling energy costs, but underlying inflation remains well above the Fed's goal of 2%. So again, this is kind of like, in my opinion, throwing salt on something that doesn't need to be thrown on. The point is, even headline or even core inflation is coming down. Is it coming down as fast? Is it lower than core or than true inflation? No, it's not. But it's coming down. These things take time, right? That's the whole point, right? Inflation and rates, they work with varied and lagged effects. So have to be patient. But really, this 2%, truthfully, is referencing, the goal is referencing CPI, not just core. So this is also kind of just trying to scare people for no reason. But that would be an excuse the Fed would have. Okay, housing is likely to be the biggest wild card for U.S. inflation over the remainder of 2023. Shelter costs carries a high weight in the CPI, and they are currently rising at an annual rate of more than 8%. Industry data suggests that U.S. housing costs in aggregate are declining. So while we still see high rates for housing, and when we say housing, this includes selling of a house and rentals. But when we see that, we see the high number now, but the thing is, the true results, the true inflation of it hasn't made its way through the CPI way of gathering of data, right? So for some reason, we do things in a certain archaic way, and so it lags. So we should eventually start seeing these lower inflation results, these lower rent prices, these lower home prices come through in the CPI, but we haven't seen that yet. Right, so that's interesting. That's something to keep an eye on. We'll touch on that a little bit more in a second here. Okay, some economists see inflation as a lot lower than what the CPI data suggests because the report's shelter cost measure is a lagging indicator given the methodology used. If they do start to decline, that could be enough to bring CPI much closer to the Fed's inflation target. Exactly, and this might be the big ticket item that is really what the Fed might want to pause for, this quote unquote hawkish pause. So if inflation tomorrow comes in at that 0.19 and we do get a 4.1% for CPI and cores at 4.3, the Fed will probably pause, right? Because it's a good number. It's a good number. And they're saying it's a hawkish pause, right? Hawkish pause. And they're potentially waiting until next month to raise rates again. Maybe they're trying to keep that in their back pocket. I think for two reasons. One, in case there is an increase in inflation, obviously, right? They want to be data dependent. They want to be able to not behold themselves to one thing or another, but also to keep the markets in check, to not freak it out, to because a lot of the power of the Fed is in the power of the podium, their voice, their command, what they're saying, what they're threatening. So they don't want to just give that up. All right, let's wrap up this article here. Okay. Um, Fed leaders have said that they don't expect to cut rates in 2023, and the market is starting to believe them after some skepticism. If upcoming inflation data continues to show rising core CPI, then it may be further vindication for the Fed's stance. However, if shelter costs do start to ease, then that may be an early sign of the Fed's policy bringing inflation under control. Again, it seems like housing is going to be what really matters here, and housing makes up the majority of CPI. Okay, so we are definitely in a we have to walk somewhat of a tightrope here with inflation. We need to show that it's still coming down. We need to report these numbers. We need to get closer and closer to 2%. We need to have the Fed believe that what they're doing is working. But we also need to start seeing some of these numbers come through to really support and really help out, help all of us out and give the Fed the fuzzy feelings of okay, we've conquered. All right. So then here's this other website. This is called Trueflation. If you've never played with this, check it out. It's pretty interesting, trueflation.com. But Trueflation tries to predict and come up with a inflation kind of on a real-time basis. It's an attempt, right? So it's not something that I would invest on or anything, but it's another data point to keep in mind. So as the article said that some economists do think the CPI is lower than what it is, Trueflation agrees with that. Trueflation believes that currently we're sitting at about 2.75%, right? You can see it here on the left and you can see it here in the chart. So inflation is coming down, right? So 2.75%. That means we're probably a lot closer to what the Fed's goal is than what we are currently seeing. And why is that? Again, because the methodology of how CPI works, it lags. It's a lagging indicator. It's not real time, and it's not the best. It's just the best way to say it. It's kind of archaic. And you would think, we could do a lot better with getting things more in real time. But if I come down here and you can see that they kind of break everything down to categories, let's look at housing because this is pretty interesting. So if we look here for housing, last month, it says that it was up 0.9%. Versus last quarter, housing was down negative 3.12%. This is Trueflation. And here you can see Trueflation has these different charts. Down here in this line, this is the rented dwellings. All right. And then the green one over here, these are owned dwellings, right? So this is essentially the appreciation of your property or also people buying houses. Down here, it's just rental prices, right? Kind of coming through. And then this is the aggregate of them, right? The housing total. Okay. So the good thing here is Trueflation is telling us that we've been coming down, coming down, coming down. However, we can see that home prices are kind of starting to go back up, and down here we can see rents are still declining. So this could be kind of a I wouldn't read too much into this as far as, this somewhat, seems like we're kind of inclining right now because we also saw here, right, kind of plateaued here. But I wouldn't worry too much about that because this is like the hot season for selling houses. So I would imagine as we go through the year that things are going to start to cool off more and more. All right. So what does this mean for Tesla? What do I predict will happen? What's my temperament? So we've been on a historic run with Tesla. Tesla is at a 12-day run rate, assuming that they stay close positive today. I believe they're still positive right now. Yeah, it looks like they're in the green. They're up 1%, $2.47 at 246.91. All right, so Tesla's up again. I think today they'll be up. I think tomorrow's where everything's really going to kind of be understood. I don't think what the Fed does on Wednesday is really going to matter because we'll be able to know tomorrow what the Fed's going to do on Wednesday. So if inflation comes in tomorrow at the 0.19, call it 0.2%, then I think everything will be as is expected. The Fed will pause. They'll have some hawkish rhetoric about, this is a pause, but we might raise if we need to in the future. We're going to be data dependent. We know what they're going to say. However, if it comes cooler, if inflation comes in cooler, watch out. This market's going to run. Tesla will have a 13th, 14th, probably possible, positive day. So it really starts tomorrow with what inflation looks like. So this run may not be over. This run may just be getting started. All right. Now, there's also something else with Tesla. Tesla seems to have become disconnected from the market. Okay. And actually, it's not just Tesla, right? It's Tesla, it's Nvidia, it's Apple, it's Microsoft, it's Amazon, right? It's essentially these, seven big names that everyone keeps talking about. So with Tesla, there's something very interesting that just happened. They're opening up the supercharging network to Ford and GM, right? They're collabing with them now. And this is such a new thing for Tesla because they just created a whole new revenue arm. Not only did they create a new revenue arm, but now they're going to have this MMR, this monthly recurring revenue that's going to come in through their superchargers from Ford and GM users. All right, now this may take a while to happen, right? It probably won't happen until next year and really take off in 2025. But this is something, and I don't think the revenue will be so meaningful because Tesla already makes really big revenue. But I think where it'll be important is for the thesis of other things, of FSD, of humanoid, of their OS, right? So the story starts to become real, right? A lot of people have alluded to an Apple services, an AWS, type moment. So this could be a big deal, and I think people are going to start factoring this in. In fact, as of this morning, we're seeing essentially every charging company in North America saying that they're going to adopt the NACS or offer the NACS as part of their service, right? So again, game set match for Tesla. I imagine Tesla will probably manufacture a lot of the NACS. Maybe someone else will as well, but I think Tesla's going to be able to get some profits from this. Now, again, I don't think this is going to be big needle moving in the way that maybe some people think as far as revenue generating, profit generating. I think it will allow Tesla to continue this somewhat monopoly, allow them to continue with the supercharging network. Because keep in mind, just because all these other manufacturers may adopt the NACS standard, that doesn't mean that they are going to have the same uptime, that they're going to have the software know how to have a certain experience. Now, GM and Ford will be able to get the benefit from Tesla supercharging networks, and Tesla opened up their APIs to these two vendors, but it doesn't mean everybody else is going to have that. Just because you have the hardware doesn't mean you have the software, which is really the brains behind everything. Again, just like Tesla's FSD, everybody can put cameras into their car and they can put the Tesla computer in there, but all of it is rendered useless. It's pointless if you don't have the software. So the software is everything, even with the supercharging stations, and people are going to eventually realize that as well. So I think there's a lot of positive news here for Tesla. I think we are potentially going to have a couple of things happen. I think that if we have a inflation come in as is expected, then the market should continue to run on this rally. All right. If inflation comes in a little hotter, then I would expect the Fed to maybe raise rates this time, but I don't think they're going to. I think either way they will pause and they'll raise rates next time. Maybe. We'll see. However, if things do come in cool or as is expected, and then we see the same thing come July, which would be a reflection of June CPI, then I think the Fed will continue to do what they're doing. Where I get a little cautious is the next 2 months. In August, I don't think we have a Fed meeting, so that's kind of a good thing for us. But the reason I get kind of cautious because now we're going to be lapping months that had 0%, 0%, right? And then we get into 2 months that had negative percentage. So if we're sitting here at a 0.2% and we're replacing the 0% with the 0.2, it's going to look like inflation's ticking back up. So we got to be careful with that. So it may look worse soon than what it is, but we're going to have to take all that with a grain of salt. If we come in at 0.2, that will show that the economy really is slowing, that the market's slowing, and that will hopefully continue the trend. Hopefully we go down to 0.1. Hopefully we go to 0%, maybe even throw in a negative or two in there. I know that would be a technical recession, but the point is we want to see the numbers come down. The faster they come down, the longer we can sustain this bull market rally. And again, just because we are in a technical recession, that does not mean the market can't rally. That does not mean we can't be in a bull market, right? The two don't exactly they're not exactly correlated. They're not tied at the hip. So I'm bullish on Tesla. I think there's so much good news for Tesla. I think Tesla is on a planet of its own. There's lots of things happening. I think the Cybertruck is going to be a big event for them. I think Q2 and what they say is going to be a big deal for them. They're probably going to announce another factory this year, whether it's Spain or India or Japan or South Korea. Who knows? But I do think they'll announce another factory. I think Tesla AI Day will be a big deal to see the progress of Optimus, see where that's at, especially if they start to show us that they're actually using it in the factory in a meaningful way. I think that would be a pretty big deal. And FSD, I mean, man, this latest version, 10.4.3, I hope they keep pushing it out or at least go to 4.4, refine, and then push it out wide because it is looking really, really good. It's getting so polished. Again, we're not quite there yet. I still think we have a few things to iron out. There's still some conservativeness with the braking, right? I know people keep saying phantom braking. I don't think that's what it is. I would just say it's like unsureness. So I think there's still a little bit of that. It still needs to get a little bit better with some like miscellaneous things, which are kind of a regression. Like some stop signs. I've seen it, kind of run through a couple of them. And it's not like it's just running through it. It's like it had a car in front of it, and it had stopped for it, and so it kind of assumes that was your stop for the stop sign, which is weird because it didn't used to do that at all. But again, I think that's a minimal thing. Um, it's gotta be able to deal with construction. Construction is a big deal, so they have to figure that out. Obviously, parking lots, right? Parking lots to me is like the last real thing, um, and then things like potholes, speed bumps, right? If we can create a comfortness there. And the speed bumps, I would think are a little easier than the potholes. Potholes might be that might be a little harder, but again, I think they just have such a massive data set that things should be fine there. And then again, if they open this up into Europe, into China, into Australia, it's going to be a pretty big deal. It's going to be a very big deal. So I think there's a lot of reason to be bullish on Tesla. I do think Q2 will be the bottom, the trough of margins declining. But you also have to be careful because we're starting to see a lot of pressure for automakers. And Tesla, sure, they're in an island on their own right now where they're having, the best months, the best quarters that they've ever had, bigger numbers. But the auto industry on the whole is actually hurting, and they're starting to really stockpile up, and they're having issues at dealerships. So don't take it for granted where we are right now because that could bleed into Tesla as well, right? Especially if things start to become a lot worse. Europe is in a technical recession now, right? They had 2 consecutive negative GDPs. So we need to be careful here and not take it for granted. However, cautiously, I'm very optimistic. I think I think we're gonna be able to sustain these levels. If we pull back a little bit, no big deal. I'll just load up some more. But I do think that we're going to be headed to the 300s plus before the end of the year. It seems like it's going to happen, especially with all the good news for Tesla. All right, we're going to leave it there. Thank you all for joining. I appreciate it. Hit the like button, hit the subscribe button, ring the bell. Talk to you guys next time. Peace.